Dave, how are you?
Fantastic. How about yourself today?
I'm also fantastic.
Good, good. So, our topic of conversation for the day is closing costs on a home loan. And
I think
there's,
that's something that a lot of people get confused by, right?
yeah, and there's a lot of them. And we talked a little bit about how it's always been frustrating to me that you can go to a car lot, and even today you can buy a car for $100,000, and literally they run your credit and you give you the keys and you drive off the lot on what is a depreciating asset. Whereas a home loan, you can close them in a couple of weeks, right? It's a little more difficult, and all the stars have to align necessarily, but there also are a lot of costs incurred on a home loan as opposed to buying a car, for example. So we want to kind of go through some of those things, what you can expect for typical closing costs, how you can actually verify between lenders what those closing costs are, things like APR or annual percentage rate, and how that's a little bit different than the actual interest rate you pay, and a few other topics. So you want to dive into just general closing costs?
Absolutely. Well, you bring up a great point too, because between yourself and a car dealer, for in that example, you have two parties. Whereas in a transaction with real estate, you have the buyer, the seller, maybe an agent representing each one. You've got a title company, an appraiser, a home inspector. You've got an insurance agent. You've got a lot of other parties that make up the transaction. And if you have a loan, you have requirements for some of those components. Whereas if you pay with cash, you don't have all of those components. And that just kind of makes it a little bit more confusing for people walking into their first home purchase, or if it's like right now, you're buying in a different real estate market era of closing costs than maybe 5 and 10 years ago. So we just wanted to kind of walk through that a little bit.
Yeah, and that's a good point too, is that, in a real estate transaction, especially if you're purchasing a home, or selling a home, you've got seller side fees and you have buyer side fees, right? Where you don't have the same thing with buying a car. So, and you mentioned a couple of things too with escrow. It's like, okay, you have to open escrow, who's going to take care of all the documentation, and the fees, are going to be held by escrow, or in some states an attorney. And then you've got title insurance, for example, to make sure that that home that you're buying has clear title when it's passed on to you, and for that insurance you pay a fee, right? So yeah, there's a lot of things involved with that. So what if we start with just kind of people know and have heard the term about APR, or annual percentage rate, but sometimes they'll get a quote and they'll say, well, geez, you called me, Eric, and told me my rate on this loan was going to be 7%, but I got the APR says 7.237. What's the difference?
Absolutely. So actually, you have to give back that car example, or when you have a credit card application, you have an APR. And if there are other costs involved in a transaction, like there might not be in a credit card, other costs involved. So the APR and the note rate at that time might be one and the same. Whereas with a car, you're maybe going to have some finance costs or some cost of the financing. With a home, you have a little bit more of that, most likely. And if there's mortgage insurance or other things, let's just say you don't put down the 20% down payment, you'll have this mortgage insurance that affects the APR. So it makes it actually a little bit more complicated because there's no set pattern in how to look at note rate and APR. And those vary based upon, APR will change if you go up and down in an interest rate on a home loan. So comparing two different interest rates and the associated APRs gets complicated because that's not apples to apples, for instance.
Got it. And the APR is nothing more than expressing your total annual cost of the loan as a percentage, including what your actual interest rate is and other associated fees.
Yeah, so it's projecting the costs over time, which include what you may have paid up front. And typically then the APR is going to be higher than the note rate by way of what other costs you had involved in the transaction.
Got it. And a couple of those things that, kind of near and dear to my heart are, points, right? So a lot of people will talk, well, how many points is this going to cost me? And so again, that's why it's really important to be working with a mortgage professional that can explain to you exactly what the points are and what the total fees involved are in applying for a loan, whether it's a purchase or a refinance. And so you can typically see two different kinds of points. You can see a points expressed as a percentage of for origination, or you can talk about discount points. And I want to go into a little detail on the discount points. But to start with, so a 1 point on a loan is 1% of the loan amount. So quick example, if you're applying for a loan for $300,000 and you're paying 1 point, that will be $3,000. So 1% of your loan amount. And a lot of the confusion, to me at least, in the conversations I've had previously with clients and family, friends, and everything else is, well, wait a second, I'm hearing all this about discount points in the news. What's a discount point? If I'm getting charged for something, because in my mind, when you hear the word discount, you think it's cheaper, right? So you're getting a discount on something. And actually the same holds true for discount points on a mortgage loan. But when you pay a discount point, you're paying that point to discount the interest rate. So the more discount points you pay, the lower the interest rate becomes. And so a lot of people don't understand that. And are like, well, I don't understand how you're saying discount, but I'm getting charged something. So that's a kind of a common term that people don't really understand of how a discount applies to them if they're having to pay something.
Well, and if you go back in time to when you and I got in the business, or 10 years ago even, you could do a lot of loan closings, whether it was a refinance or a home purchase, and actually have enough premium built into the rate to cover some or all of the closing costs and not even mess with discount points or things of that nature. And the CFPB actually recently came out, the Consumer Financial Protection Bureau actually came out more recently with a study saying people are paying more in closing costs. Are they paying more in closing costs effectively, or are there just more upfront charges for the interest rates? Because actually, the market behind the scenes is not paying up for loans at these interest rates of today's marketplace, because there's a perception that over time we're going to see rates fall off again a little bit. I think we're filming this in May of 2024, and for a while now, there's been this concept that the Fed may reduce interest rates that they elevated a couple years ago. And therefore, lenders that would be buying into that interest rate and offering those interest rates don't feel that the loans will be on the books for an extended period of time, meaning they're not willing to pay up for those loans today like they did even during the pandemic. And so they're not giving the lender enough opportunity to cover costs or not have discount points. So unlike maybe let's just say 10 years ago, most loans come with points, and the idea of a discount point is to buy down the interest rate. Well, today there already isn't enough premium in the interest rate to cover costs generally, and so you have to pay points up front in addition to those standard closing costs to be able to arrive at financing today under most loan programs and most types of, especially if it's an investment property or things that buy up the interest rate anyway, given a little extra risk with investment properties.
Yeah, that's a really good point, because even there was a pretty good chunk of last year in 2023 where you couldn't even get any rate, without paying at least a little bit of a discount point or percentage. And by the way, so you're not always paying a full point for discount. So it's not a full 1%. It can be everything from, a tenth of a percent, and it varies from, as you buy up or buy down your interest rate from rate to rate. But again, there were some points of last year where you couldn't even get to a rate that was available without paying at least a little bit of a discount point. And to your point, there was times historically when rates are a little more stable, or there wasn't the expectation that rates were going to come down at some point, where you could get pricing that was better than what we call par by a point or a point and a half. So that same $3,000, 1 point you pay on a $300,000 loan, we would have as the ability to give a lender credit in that same amount of that $3,000, because we would basically be getting pricing that was 1% better. And so we could give back a lender credit to be used to offset some other closing costs, which again, in this market recently, we haven't really seen.
Right. Absolutely. So different eras of interest rates offer different opportunities for closing cost coverage, for a, like you said, kind of a par rate where someone will pay the closing cost, the line item fees, but not have to pay into the interest rate. And in today's marketplace, lenders aren't really giving that extra nudge behind the scenes. So some or all of the lenders, the originating companies, commissions, earnings, revenue that offsets all of the costs that we incur, that has to be paid up front. And so it's in the form of a discount, but it's also fractional. So, like you said, it's not like you pay only 1 point or 2 points or no points. It could be 0.378 of a point. It could be some sort of fraction. And one thing that if you've financed in the past, if you've been a borrower, let's just say 20 years ago and 10 years ago and 5 years ago, you used to see more of a stair step on a 30-year fixed product, let's just say, of about a half point bought you about a quarter in interest rate, or an eighth in interest rate. Excuse me, I screwed that up. And a point bought you a quarter in interest rate. So you
Right.
could kind of stair step that about a half point was about an eighth interest rate up or down. So if you paid a half point, you get an interest rate of an eighth better. If you didn't pay half a point, you'd get your interest rate. And if you wanted a half point credit against your closing costs, you would take a slightly higher interest rate of an eighth there. And that was pretty consistent in the target zone, and that's kind of washed away in today's marketplace where lenders aren't paying up for those premiums. And so the stair steps are all a little wonky, if you will, from what we've seen historically in this business.
So that said, after the crisis of the 2008 mortgage and real estate crisis, the CFPB was born. And one of the things that they tried to do was to try to explain and show how to compare mortgage financing. And one of those things was through something called the loan estimate, which is probably the best way to truly shop and compare for mortgage related fees. Because again, if you talk to a mortgage advisor that says, I can get, I talk to you today and I say, hey, I can give you 7% and here's the associated fees. And somebody else calls and says, oh, well, no problem. I can give you 6 3/4. You're like, well, I'm going to go with that person then at 6 3/4. But the reality is you got to ask all the questions, including at your 6 3/4, how much is that going to cost me in lender fees? And inclusive of discount points, right? Because they may be pricing in a discount point that could buy the rate down from 7 to 6 3/4 that I didn't quote you. So you need to make really sure that you look at the loan estimate. You have a little more on the loan estimate, Eric?
Yeah, so the loan estimate, there used to be a couple disclosures that now are incorporated into the one loan estimate. And there's this concept of a preliminary set of numbers versus more finite, so more defined numbers at the time where you have a more defined situation. So if you're buying a home and don't have a property yet picked out, you can get some preliminary kind of estimates, guesstimates, because there's, even things about the house's property taxes or what have you, those aren't really going to be known until we get more specific. Once you have a property and specifically an address, it's time to get the real numbers out. And that's on the loan estimate, and lenders are required to do that within 3 days of discovery of the fact that you, the buyer, the borrower, have identified a property. So that also then exposes, okay, those are the costs and those have to be firmed up. And there's tolerances built in where once we have the more information specific to the property and we've defined what loan amount and what down payment and the terms about the financing, it's time to get precise. And you don't have to lock the interest rate just then, but it's time to get precise. And there's margins where some fees can't increase at that point. Some fees have a reasonable 10% or so, change, and so the consumer can feel much more confident about what they're doing when they're shopping at that time. But a big catch here is that people, going back to kind of how you introduced this call, the the APR can only be effectively compared if the numbers in that loan estimate are accurate. And then it can only effectively be compared same rate to same rate. because a lower interest rate can have a corresponding lower APR, but have a bigger spread in that APR. So more fees could be associated into that lower interest rate than might be necessary one lender to the other. And so it gets a little bit confusing because you don't just shop APR. What you really shop in a home loan, in my experience, once I've explained it and watched everyone else explain with their customers, is the interest rate and the costs to get that interest rate. And I think that's what's confusing about APR in a home loan.
Right. Absolutely. Well, that's why it's really important, again, if you're shopping for a mortgage, to make sure that you're comparing loan estimates, and really that's the best way to do it, line by line, exactly what you're getting charged for everything. Again, in addition to just what the interest rate is, there's a lot of other fees involved.
Absolutely. And so the biggest thing here too would be that, especially if you're a new first-time home buyer, or if it's been a while and we're in a different marketplace today, get with a lender early. Figure this stuff out early before you're getting excited about specific homes, because all of this can start to be nuanced and figured out together. And that's much better to do than to go try to get a quote once you've found a house. That's kind of the mistake in mortgage finance and home buying is let's get prepared and understand payments, understand loan programs, understand down payment options, and then work our way into finding a home.
And in today's market too, with such a shortage in inventory, it really makes it important to get with a mortgage advisor that can actually get you pre-approved instead of just pre-qualified, where they're actually going to submit your loan in to an underwriter, go through all the income calculations and everything else, and just give you a really good, true pre-approval, and you'll have a much better chance of getting your offer accepted with a strong lender and a strong pre-approval.
I don't think I can emphasize that enough. What you just said, Dave, is the quality of the experience of the transaction really rests on what you just defined with respect to getting it done early, getting the question marks around the qualification of the borrower ready, identified, underwritten, good to go for that home purchase. Because once you are in line to try to buy that house, it's a competitive market out there, and we fully expect that as interest rates maybe do ease up, let's just call it over the next year, we're kind of thinking that at this point, but this has been an extended time of higher rates. But if things start to ease up a little bit, that's actually not going to get home buying to be easier in some ways. That means there's going to be more competition for the homes that are for sale, meaning you really have to present the best picture, the most completed checklist of items beforehand, so that there are very few, if any, questions about your ability to buy when it's time to make that offer.
It's great, great point, Eric. Well, thanks for everything on closing costs. Hopefully everyone learned a little bit more about closing costs. Again, we always suggest that if you have questions, you should always, always, always consult with a mortgage professional that knows and understands your complete financial picture and what your short and long-term goals are with homeownership.
Absolutely. Working with professionals is key. Thanks, Dave.
Thanks, Eric.